Hello, my name's Kate Mason, and I'm talking today to Tashi. Tashi hosts a podcast called Taschi Talks, and we're going to be explaining social impact bonds. So I had a very long career in the welfare field, and during the pandemic measures that were brought in by our government, I became incredibly concerned, as well as a number of other welfare workers, regarding the enforced and coerced vaccinations and also multiple lockdowns and the ruining of people's careers and work lives. We became very concerned about how these measures were going to impact the most vulnerable families. So we wrote together to politicians and talked about harms, increased domestic violence, children's learning plummeting, parents losing children, not being able to get access to courts, drug and alcohol programs closing, and many more other issues. So we wrote to politicians raising these concerns and asking how did they assess that COVID was more serious than the measures they were bringing in. And we didn't get many answers, or really any answers to that question. So during that time, and the great distress a lot of us were experiencing, I stumbled across Tashi and her podcast where she was unpacking social impact bonds. And that was the first time I'd heard about it, even though I worked in the industry for 20 years. And so social impact bonds are a way of making a market off people, off the vulnerabilities of people. And so from then on, thanks to Tashi and her giving me, the information to start looking, became more increasingly concerned about this model. So it's a great pleasure. I have a deep appreciation and respect for Tashi and the work she's done. And we wanted to come together to unpack this and explain this. And this is particularly relevant to parents and also to welfare workers to understand the new model that is going to be implemented in your field. So thank you so much for Tashi for joining me today.
Hi, thanks, Kate, very much for having me. Unlike you, I don't have a welfare background. I have very much a corporate background in business. But I did live in Melbourne. I still live in Melbourne. And so Melbourne's the longest lockdown in the world or something crazy. And it did not make any sense to me. Even on the face of it, by the government's own rhetoric and risk assessment, it still was, for the most part, completely nonsensical. And I don't like doing things that don't make sense. So I went on a bit of a journey to try and find out what lens I could look at that would explain the government response to COVID, because it certainly didn't reduce transmission or any of the things that they said of an apparent virus. So I stumbled across the work of Alison McDowell, and I set myself the task of understanding whether or not that was being rolled out in Australia. It's a new economic model called impact investing. And on the face of it, it is sold to the public as a win-win, that government and large philanthropic organizations will help invest in some of the most pressing and complex challenges of our time and get a return from it, an economic return. And it's often sold as a win-win. And so I think today, if we can discuss together why neither of us feel it's a win-win, we feel very much it's a win-lose.
Okay, so here we have the model, which is about commodifying people and making a market off them. So these are just a few slides I've collected. There's many, many more around the harms that were caused to people through the government measures to COVID. Not through COVID, through the government measures to COVID. So they always say COVID did this. And it's an important distinction. Learning for 1.6 billion students has been derailed. A huge amount more homelessness. Australians pushed into homelessness each month as the housing crisis deepens. Mental health, this is the World Health Organization. COVID-19 pandemic triggers 25% in increase in prevalence of anxiety and depression worldwide. Domestic violence surging amid COVID-19 lockdowns, research shows. Extreme stress, Australian businesses risk going under due to the impact of Omicron. And alcohol consumption increases during COVID-19 crisis. Now, they're just only the tip of an iceberg. There were people setting themselves on fire in Melbourne as well. There were just horrific things that were going on. And this article, what has economics got to do with it? The impact of socio-economic factors on mental health and the case for collective action. So in the welfare field, you know very clearly that the more strain and the lower socio-economic, the less able people are to be able to purchase their basic needs, the more societal issues people have. There were huge amounts of articles outlining this along the way. And this is also generational trauma. These things don't just go away in a few years. This causes generational distress and generational vulnerability.
Yeah, thanks, Kate. That's right. There was so much coverage about how effectively what was a healthy society through the government response to COVID, many people were pushed to the margins into dysfunction. And I'm going to show here how effectively that was creating new markets for impact investing. So you might ask, what is social impact investing? We touched on it briefly, but here it is out of the AFR. It's investors seeking to generate both financial return and social value, while at a minimum returning capital, and in many cases offering market rate returns or better. The model is where large philanthropic organizations lend the government, which is now broke, apparently, the money to provide social services. This is the privatization of social services. And I'm going to show how it's actually more expensive and the taxpayer pays. The premise of my view has always been that this is not a win-win, that social impact bonds is a means to profit from human suffering. And this concerns me greatly. I'm not alone in thinking this. I arrived at that view on my own, though I did find that there are other people out there who share that view. And I've put a screen up here from someone called David McDonald, who wrote even back in 2013 that social impact bonds profits from human suffering. In the 10 years between 2013 and today, it's actually been embraced by governments all around the world. And it's being embraced right now by Jim Chalmers, who's the treasurer. So this is from February this year, Jim Chalmers, why he's backing social impact investing. Now, it says here he was inspired by former Macquarie banker Michael Trail, an Australian pioneer of social impact investing and an advisor to successive governments. And they want to expand investment to achieve well-being improvements in society and financial returns for investors. So now we're conflating and commingling the well-being of society and huge financial returns. It's not just Jim Chalmers. This has been going on for the last 10 years and is absolutely endorsed by both sides of politics. Scott Morrison endorses social impact investing. It's called social impact investing, and it sounds too good to be true. Yes, I agree. It is too good to be true. Daniel Andrews, he eyes social impact bonds for Victoria. That's right. Definitely, he's created the market. And Julia Gillard, since leaving politics, she's actually joined the board of the largest impact investor organization, I think, almost globally, called Leapfrog. This is one of her growing list of corporate and non-profit ventures. And we're talking billions. This is a $2 billion fund. So if I just mention briefly the history of social impact investing, the first bond was created in 2010 in the UK. And in the subsequent years, it was trialled around the world. And back in 2017, the Australian government committed to being an enabler and a developer of the market, with around $53 million at that point invested to grow the social impact investing market in Australia and to create innovative solutions to entrenched social issues. Now, working in the corporate world and in data, I can tell you that whenever you see the word innovative, it means digital and it means data. In 2019, the government created a social impact investing task force to develop a strategy for the Commonwealth role in the market. And always I see organizations, individuals taking their positions on things in 2019. Like I said, it doesn't matter whether it's Labour or Liberal, they're both championing it. Well, what's the future of social impact investing? Well, a report that was put out recently shows that by 2030, it's always the same timeline to 2030, which aligns with Agenda 2030, it will be a 253 approximately $1 billion market. And this is, I forgot to cut the bit out, but it's actually a compound growth of around 18%. This is absolutely extraordinary. This is impact investing on steroids. The article that I took this from, it's from a Yahoo Finance Yahoo article. It says here quite clearly that the COVID-19 pandemic positively impacted the impact investing industry. Now, a pandemic alone didn't do anything. It was the government response. And I don't believe that it was entirely coincidental. It increased social inequality. And as I said, and you highlighted and you saw firsthand how it impacted families, pushing them to the brink. It put so much pressure on families in so many ways. I've listed here, and working in welfare, you may recognize some of these. And I've listed them here. Anyone watching can go through these. There was a New Pin South Australia social impact bond, side by side social impact bond. This was around getting Indigenous and Aboriginal children back into school if they were not very focused on being at school at a very young age. And not every parent wants their child to go to school, but now it's seen as something that is absolutely crucial to their well-being, which I would argue. What do you think, Kate?
I think it just all depends. It's all the motivation that concerns me. When it comes back to a way that children are then linked into some metrics, and then investors are making money off it. That really concerns me. So it's always the motivation, is hugely important to unpack as to why things are motivated in a certain way, and then what that means. I'm concerned about the push now for children to go into preschool, and
Yes.
and then there to be an extra year of school prior to kindergarten. From when they're 4, and the impact markets that will be created around that. So impact markets where children are assessed at particular ways along the line, and then they're going to be picked up by impact bonds for investors to invest in them.
I agree. And I think that would be we could talk about that in another show in itself. There's so much to unpack there.
But I wanted to go, I should have jumped in at your last slide, because when you talked about, can you go back to that last slide? So when they say this, the pandemic has underlined the importance of social and environmental considerations in investment decision, and the crisis has brought issues such as public health, social inequality, and climate change to the forefront. I have seen that over and over again, where they speak about COVID showed up the cracks in society.
Oh, yes.
And this narrative they've crafted, that it's showed it up. It's in the Rockefeller Food Report as well. It's with everything, with every measure that they're bringing in. It's COVID showed these cracks, and now we have to fix those cracks. So they never speak to that they actually created a whole bunch more disadvantage through the measures they brought in and the massive transfer of wealth that occurred alongside that.
Correct. They always couch it as shining a light on these problems, as though these problems existed, and yes, they did, but they have been exacerbated at such pace by the government response to COVID. And this is what I call making markets. I'll show you exactly how they do it. Let me show you on this slide how a social impact bond process works. What the government sees, or what the public see rather, is service providers. And when I say service providers, I'm talking about people like Launch Housing, Sacred Heart Mission, Mission Australia, Anglicare, a lot of non-profits or charities that traditionally have done a lot of good work on the front line with welfare recipients. And they deliver services to people in need. What happens is that their money no longer comes up front from the government. It actually comes from an investor. That's the impact investor. Now, how the impact investors finance the service providers in itself sets up a whole new market, a whole new range of jobs and small service providers acting as an intermediary. You can imagine that is like a mortgage broker, if you like, a brokerage type organization that matches investors with service providers that are meeting the social purpose that they want to fix. And then there's some independent evaluators that will evaluate whether or not these service providers are doing a good enough job to tick the boxes and meet the targets that have been prescribed to warrant a return on investment. Impact investor supplies the money to the service provider. When the service provider can prove that they've done a good job, then the government pays back the impact investor with a return on investment. Then they get money. Now, that return on investment is taxpayers' money. So not only is the taxpayer basically paying for the service provision, but they're actually then paying over and above in the form of a return on investment.
So the other thing they talk about is mitigating the risk for the investors. You can leave the bond early because there's metrics associated. So they need like a 60%. So say with new pins where it's about children not returning home, so they're not in care, returning to families. So it's a program that supports families. So they have to have a certain metric. So I think it's around 60% of children need to be returned back to their family for the investors to get a full investment, basically, their full investment, which was around 10% to new pins. But there's also ways of mitigating the risk for investors that they speak about quite a bit. And with new pins in particular, that ended up being $5 million in interest, or $5 million over their initial amount they put in. They received $5 million collectively. So that is the government paying $5 million more than if they just funded the welfare organisation to run that program in the first place, which is the old model, that the government would give money to community centres or neighbourhood centres to run programs that were essential to people, within their area. Now the investors are getting more money, and the government's giving more money to them than they would originally.
Correct. That particular bond costs $7 million. And upon completion of the target being met, the investor was paid back their $7 million with $5 million on top. I don't believe that all of them going forward will be so lucrative, but they had to put some really good juicy ones on the table to create the market and create the interest in the philanthropic sector, to get them piling in, and they are piling in now. My argument is that what's been happening over the last few years and is continuing to happen is actually creating a market for social impact investing. Once again, what the public sees is the service provider helping a target cohort, be that homeless or mental health provision. And notice here they are targeted, right? And these are often not-for-profits. And so people think this is all nice. Everyone is doing stuff not for profit anymore. Isn't the world a better place? It's a new capitalism. It's a kind of capitalism. Well, it's not. It's just that the profit isn't made at that particular level. The profit is made from the investors and the government via the delivery agencies. And it says here that this will return money to the government. My argument is that actually, how many areas have we seen increases in need due to the government policy, especially during the last 3 years? We've seen an increase in homelessness. We've seen an increase in mental health issues. We've seen an increase in educational disadvantage, an increase in domestic violence, an increase in children requiring care, an increase in unemployment, an increase in local loneliness and social isolation, and dare I say it, not wanting to trigger anybody, but an increase in suicide. All of these are areas that are targeted for social impact bonds. We are creating the market. The government policies are creating the market for the investors.
And it's a faulty narrative in my mind that they say it's saving the government money because if this social issue wasn't dealt with, it would, that's how they say it. So they cost that social issue if it's not addressed at all, and it's going to lead to prison, or it's going to lead to children being removed for families or whatever else, and then they cost all of that to the government. But that's a faulty argument, because regardless of what you think of welfare programs, I think there were issues with the old model of welfare programs as well. It was very top down. However, there were welfare programs in place. It wasn't that no one was addressing these issues, but they cost it as though there was nothing ever in place in the first place.
Yes, they argue that this is saving. that this saves money in the long run. And I will show you why I think that's, again, a faulty argument. So the examples, and I've pulled some examples here from it. So social impact bonds, for example, are a program supporting in-home care for Alzheimer's patients, would lessen the demand for residential aged care. What it doesn't do is address why, or the seemingly increase number of Alzheimer's patients. You need to have Alzheimer's patients for this social impact. So there's no interest here in identifying what's causing Alzheimer's or in any way to try and reduce it. The other one is an effective intervention to lower criminal reoffending rates. That would reduce costs associated with keeping inmates in prison. But once again, this isn't about creating a healthy, functioning society in which people don't feel the need or compelled to commit crime. This is around only mitigating the future cost for someone who's already been identified as a problem. So in other words, they don't reoffend, they don't do it again. Another one is homelessness services for youth or older women or long-term homeless people. This doesn't solve homelessness in itself. You actually need homeless people to provide homelessness services too. The other one is improving employment outcomes for long-term unemployed young adults. Yes, you might take an individual and you might help that individual so that he finds a job, but you need long-term unemployed people as your target cohort to begin with. My daughter actually said this. She said, basically, this is making money from Band-Aid solutions rather than actually fixing the root cause. I believe this to be so 100%. I want to just quickly touch upon something about if the intervention model is successful. Investors lend money to service providers and they ask them to do things slightly differently because they want to show evidence that their things are working. The target cohort will be asked to provide data on whether or not the service provision has been successful. So for example, if you're receiving a mental health program, you'll be asked to fill in a questionnaire, do you feel better? Has this made a change for you in a positive direction? And you will tick that. My question is if the intervention model is successful, let's treat it as a proof of concept, if you like. Well, if it becomes more successful than traditional welfare delivery models, then okay, by all means, use philanthropic funds to fund the proof of concept and give them a return on investment. But thereafter, there's no reason to continue to use philanthropic investors for the upfront payment. The government should be funding these new improved models themselves, thus saving the ongoing return on investment payment that's made to the investor.
Yes, that's a very good point. I also have read articles where they talk about the investors are only going to invest in things, in programs that potentially already have a successful model. They're not going to invest in anything that's risky or a new genuinely innovative idea. So it's going to be the social welfare programs that are potentially already got a good track record. But the big thing I'm also really concerned about as a ex-welfare worker is the effect it's going to actually have on the welfare work that is done. The main thing with welfare and being somebody that can support somebody when they're going through a difficult time, which is how I always saw the work I did, is the main thing is actually the relationship you build between the person you're working with and you as the worker. It's trust, it's long-term, it takes, generally long-term, it can take time to get to understand that person that you're working with and what's important to them, how they want to see their life look, what sort of supports are there that actually really are genuinely targeted to that person. And I mean that targeted in a way like that actually could be helpful to that person. So yes. All of that is going to go out the window because it's just going to be pressure to get a certain metric at a certain time, because otherwise that welfare organisation is never going to get the funding again.
Correct. It becomes a tick boxing exercise. And I have had people who work in the industry, some people say that that's increasingly what they feel it's becoming. And what it does is it drives certain behaviour. I know in England, some time ago, there was some targets put on children to be put up for adoption. And so councils, to meet targets, were basically taking children off of perfectly fine parents and finding reasons to put them up for adoption to meet their targets. And my concern is that service provision in this country around vulnerable people will look more and more like that. And I don't think that serves either the recipient or the welfare worker really in the long run at all.
No. And also, how much is it about, as you've talked about, keeping people in certain models so they can go into other social impact bonds or go somewhere else into something else that's being commodified, rather than helping them get out of the system in the first place and not getting trapped in the system.
So let's have a look at who's involved in this. When I say large philanthropic investors, let's go through some of the people who are involved. So philanthropy, as we understand it, or as the public would understand it, is donations of money. And my question here is it really philanthropy? Just recently, there was a new Foundations Alliance on impact investing created by some of the largest funds in Australia. There is growing interest in impact investing. There is a lot of money to be made from it. I think we've shown that in the slides tonight. So one has to question what the motive is. Is it really for better outcomes, or is it really to make money? When we look at some of the groups, which include the Paul Ramsay Foundation, the Macquarie Group Foundation, the Westpac Foundation, the UBS Optimus Foundation Australia, we've got the Minderoo Foundation, Hand Heart Pocket, the Lord Mayor's Charitable Foundation is quite large in this, English Family Foundation and the Snow Foundation. All of a sudden, these people have found their social conscience, and this isn't an exhaustive list by any means. They have found their social conscience and are very keen to, and I'm not going to use the word donate because it's not donations, it's investment. This isn't something that's necessarily open to normal, what I would say, mum and dad investors. We might want to help as well, but it's not necessarily open to us because the minimum size of the investment required is often beyond the reach of the standard Australian. There's a vehicle by which they do it, and I want to touch upon this. There's something called private ancillary funds. They're called PAFs. They are for strategic and inspiring philanthropy. What it is, it's a type of charitable trust that offers an effective and strategic way to manage philanthropy. You donate money into the PAF and receive an immediate tax deduction. And then you use that money put aside to give, and I'm going to not use the word give there, I'm going to invest in the charities of your choice each year. You can give it to charities, but you can also invest in social impact bonds. So these charitable trusts aren't just for giving, they are also for investment, and they receive the return on investment. Now, what I want to say here is that the large organisations, if we look at, say, the Minderoo Trust Foundation, that's Twiggy Forrest Fortescue, they earn lots of money, lots of profit, which should or is apparently taxed. But if they move money looking philanthropic in the way they do that to these trusts, then they're not taxed on that. So that money that should be used for the service provision is actually taken out of the equation. And then what happens is then the government taps these organisations to lend them money for the service provision, which upon a positive outcome, the taxpayer then gives a return on investment. So this is like a double whammy on the tax base of Australia, which is people like you and me.
Unreal, hey? So, yeah, I think the word philanthropy, it's really good you're unpacking that, because I think it puts people into they just don't question once the word philanthropist is, or a philanthropy organisation is mentioned. It just goes under the radar from there on in. But as you've made very clear, they're not philanthropists. How can you be a philanthropist organisation when you're making a profit return?
That's right. And what I'm going to say here is we hear often about the circular economy. And I put a different spin on it here, that this really is the perfect circular economy, because as long as you can create a never-ending list of problems, then there's always a new market for investors. Now, I think we probably would need another podcast to talk about this, but every single new cohort of children entering school becomes a new cohort of potential market. And increasingly, we're seeing in the schools stuff that I think would make many people question their sanity, frankly. And so, and we're getting mental health providers put into schools. And so are we actually creating each year a new market? Because one of the social impact areas is definitely mental health in children. And there's more and more data being collected on children in schools. And I think a lot of parents don't realize each child is seen as a potential for an impact investing bond, because it used to be that children were identified at risk of, say, physical harm. Then it moved into, mental health, mental harm. Now it's seen as, is that child at risk of not reaching its full potential? Now, I don't know who gets to define what someone's potential is, but the needle is moving, and that creates opportunity for these impact investors.
I will put up the New South Wales education, so I'll put it up on here, the wellbeing surveys they're now doing in the schools weekly, where children have to rate from 0 to 10 about how happy they are about such things. So this is from year 7 onwards, 12 years of age. How happy are they with what they have in terms of financial things, or how happy are they with how safe they feel? So there's a lot coming in under the wellbeing label, and then we've got the wellbeing charmers budget, which we should unpack in another session.
Yeah, that's probably, I wanted to try and just keep it at a high level for people to understand that there is some moral questions around this new economic model. There are plenty of people doing good work, don't ever get me wrong, and a lot of people trying really hard to fix these problems, but there are also certainly plenty of policy that seems to be creating these problems, and I don't think we can look at them both separately. So thank you, Kate, for having me on to try and meet with someone in the industry to try and explain why it's of a concern to me anyway.
So the information I've got that who can invest in these social impact bonds are people or entities that have net assets of at least $2.5 million, or a gross income for each of the last 2 financial years of at least $250,000. And then it goes into all the different other investors, the financial services, superannuation funds, etc. So it is a very high level investment, as you were saying. The other point I really want to make just quickly is that as we're entering more into public-private partnerships, where private companies and corporations, so Chalmers has got the investment roundtable with superannuation funds on there and BlackRock and banks, etc. So they're actually creating policy with government, and they're also the ones that are benefiting financially through these social impact bonds from the effects of certain policies that come in. So that's a very problematic model in my mind. Yeah, thank you. And we will come back and talk about different things as they come up, including the wellbeing budget and how children are being affected. But thank you so much thank you so much, because I don't know if without you and your podcast, if I would have even understood this. I'm very, very disappointed that the welfare industry hasn't been talking about this, and that peak bodies have not been raising concerns around this model. Even without the pandemic and the things I was seeing that were concerning me, I would have always thought this was a very flawed, very dangerous model. So thank you so much for the work you did.
Thank you, Kate, for yours too. Thanks.